It is now my pleasure to turn today's program over to Naik, Director, Client Portfolio Manager, ClearBridge Investments, a Legg Mason company. The floor is yours.
Thank you very much, and I hope everyone can hear me. And good afternoon, and thank you for joining the PM Perspectives webcast. Today I'm joined by Elisa, Mazen, and Michael Testorf, co-portfolio managers for the ClearBridge International Growth Strategy. Elisa and Michael will provide an update on the macro backdrop, as well as an update on the portfolio. Elisa, Michael, thank you for joining us, and congratulations on the continued success with the strategy as well as performance over the long term. Before we begin, Michael did talk about how to ask a question. So if you have any questions during the webcast, on your left or as you see it on your screen, you'll see a box for asking a question. Please ask your questions during our presentation, and we will take them as they come through. But let's begin with the elephant in the room, Michael and Elisa, if you don't mind. And so how important are U.S.-China trade relations in the context of global growth, and where has the impact been the greatest?
Thanks, Nick, for the question. I will start a little bit with a broader picture perhaps first, and we prepared one slide just to get everybody up to speed where how big or how important international equities are. We do have at the top of the slide, which hopefully is coming up soon. Sorry, we have two big pie charts there, and just reminding everybody, because sometimes one forgets about it, how actually our benchmarks are built up. So, for example, like the MSCI ACWI weighting, which you have on the top left, is showing that the U.S. has a weight of 54% of all listed securities in the world. That's very, very big. And emerging markets have only 11%, and roughly 1/4 of that is China. If you go to the right-hand side, you see what is actually global GDP and how is it distributed. So 50% of the market cap is actually representing only 25%, and that's the United States, being the biggest economy in the world. Number two economy actually is China, and it makes almost half of the gray part, which is the 41%, and to be precise, China has 16% of overall GDP. So therefore, what will happen over the years, and that's the reason why I'm coming a little bit to these kind of distribution charts, is with the inclusion of China and their A shares, the weighting of international will become bigger over the next years. We had the first one already this year. There's another one inclusion coming in fall, and then further inclusions of China A shares in MSCI later on in the years to come. And also, I would like to refer to the chart at the bottom, which shows how did actually the S&P 500, which is the blue line, do versus ACWI ex-US, that is everything outside of the United States, including the emerging markets. And I mean, the perception sometimes is that why go international because the US has outperformed so much. But if you look at it, if you put it into perspective a little bit, so from up to 2008, the U.S. was outperforming, international was outperforming. In particular, international was very strong from the years 2002, 2003 into the financial crisis, where international was outperforming the U.S. by a factor of 2 roughly. In the financial crisis, all of them went down, basically pretty much a similar thing. And then something happened. It diverged very, very dramatically from 2010, 2011 onwards, where the U.S. is outperforming international by a large factor. And there were a few reasons for that. And one was definitely that the central banks have reacted overseas much later than the U.S. The U.S. started right after the financial crisis and didn't take the foot off the pedal, whereas the ECB, which is the bigger part of our overall international weight, put the foot on the brake and restarted in 2015. So international markets are definitely behind in terms of recovery versus the U.S. That's one. The U.S. secondly did better because there was more technology, and technology was a big winner over the years. And then thirdly, U.S. companies over international had higher ROEs, and good part of that actually is coming through share buybacks. The U.S. has done extremely well through their share buybacks and have used their balance sheet and put even more debt on their balance sheet in order to afford more share buybacks, and were pushing up return on equities and therefore also valuations. And then fourth, not least, was the Trump effect, where you had the tax cuts which pushed U.S. equities even further. So where does it lead now to? At the end of the day, what happens over the last years, everybody is positioned pretty much one-sided. Everybody is in U.S. equities, in U.S. bonds, and in U.S. currency. So if that would reverse like we had seen it in 2002, 2003, that would be very, very powerful for international markets. Then in terms of valuations, there's a little box in the middle. Hopefully you can see that there. I just put a few multiples in there, and where do we stand versus 20-year average and so on. So you see, we're not like crazy expensive. We're a little bit more expensive than 20-year average in the S&P 500. We're less expensive than on the international side, not by a big margin. And then we look at dividend yields. So for example, like in the US, we have lower dividend yield, but also compared to bonds, 10-year bonds, we have a negative yield spread to equity. So dividends are lower than what you would get in the bond market, which is opposite to the ex-US, the international markets, where bond yields are sometimes even zero or minus or just above zero, and we get a positive spread. So here, that is definitely an attractive part too. Currencies, we haven't even talked about currencies yet, but that could actually be also another factor which moves international. And then we come to what can actually be the one which reverses, which is the trigger, and that is, at the end of the day, and what also led to this one-sided positioning is actually the trade war. And if we could come to a kind of conclusion on trade war, that would be definitely very positive for international markets. So can I tell you, I definitely cannot tell you when this trade war has to end. And the point is only, which makes me somewhat comfortable about it, that the longer it lasts, the bigger the impact will be on the economies, and that also would mean there would be impact on the stock market. And if Mr. Trump wants to be reelected in 2020, and stock market is bad and economy would be bad, that would be definitely not a positive. So coming back to your question, who pays for it, right? At the end of the day, everybody pays for it. There is the direct impact where you have the U.S. consumer paying. And actually on the last round, the 10%, the consumer paid even more than the tariff hike was. That were some of the smart people at the universities basically pointing out. But more important for me and for international markets is actually the secondary impact. And that's very difficult to measure because this is sentiment, right? So, and people, if they are not having the confidence and sentiment is bad, will not invest more. The consumer did very well over that period. But in order to have the next leg in the international market, the corporations have to do well. And here we have seen that CapEx was on very low levels opposite to the US. We have like CapEx to depreciation ratios of roughly 130, which is at the low end of the band. And what we need is confidence back into the economy and in trade, and that would basically make the stock market react very positively on it.
The other thing I'll add to that is while we are right now, of course, very focused on what's happening with the U.S. and China with regard to trade, certainly that isn't the only tariff dispute that we've been getting involved in. We've been having issues with Canada, with Europe, particularly on autos, the Japanese as well. So there are many issues that are going to need to be resolved. And I think Michael's point about confidence and companies wanting to make long-term decisions on where to put money for factories and capital. I mean, all of these things they actually do require confidence. So we're hoping that we'll see resolution on many of these issues sooner rather than later. Probably the G20 meeting in Osaka at the end of June will hopefully put some clarity around this. Xi will be there, Japan will be there, so hopefully maybe election season will be gearing up and we can get some resolution there.
Great, thank you. So continuing that China theme, which is to say, what stimulus policy has China incorporated to offset the impact of tariffs, and do you see that working?
So the short answer, is it working? Yes, we see first little signs that it's working. So just to put it into perspective also, the China stimulus was very, very massive over the last 2 years. So we're talking about roughly 5.6% of GDP spread over 2 years, 2018, 2019. It's definitely more targeted compared to the big stimulus which we saw in 2008. And here, what are they targeting? They're targeting liquidity in the market. They gave certain special government bonds. They gave tax cuts to the consumer, but also to the corporation. They reduced VAT, and they made up for certain impact on tariffs. So that all added up to 5.6%, which is in absolute terms the biggest stimulus China ever did. We sometimes forget about it because the economy grew during that period. Also very, very important is if you want to have an economy which is supposed to grow, you have to give it liquidity. And liquidity, which you can measure in M1 or M2, is the critical part to watch in China. So what happened in 2015-16, where we had the last stimulus, they pushed a lot of liquidity into the market, where they figured out, because one way was the shadow banking system, and they put the brake on the shadow banking system very, very dramatically in 17 and into 18. And money supply from high double digits moved basically to zero. So you didn't have additional liquidity. You didn't have the chance to give additional loans and whatever. So what had the government done in order to do the stimulate into the economy again? One was, and that is powerful, but it takes some time until it filters through. These are the so-called RRR, or reserve requirement ratios for the banks. Basically, you bring them down, and the banks can lend more with the existing capital they have. So we have that done multiple times, and finally, in January, February, March, we have seen positive M1 growth again, finally. From the zero level, we're going now somewhere into the low single digits, mid-single digit region. So, and perhaps addition to what you were mentioning, if the trade war gets fiercer, China will do further stimulus without any doubt. And secondly, they will also most likely devalue the currency, which could be a little bit ugly for the rest of the world.
I think what's important when we talk about a lot of these macro issues is that when we look at the economy in China, it's quite nuanced in terms of what is growing, what is not growing, what is really impacted by some of these trade issues. What we find, particularly as we're growth investors, is some of the more traditional state-owned enterprise industries are much more impacted. They're also more levered, so those can be a little bit more worrisome. And we find that China is trying to grow very quickly in certain areas where they really haven't had much expertise. They're trying to develop their own pharmaceutical industry. The consumer has reoriented and is starting to spend in a meaningful way in areas where they haven't traditionally spent, like in cosmetics and skincare. So we're seeing some new business models being developed around the cloud, e-commerce, etc. So there is a lot of growth within China. It is not necessarily linearly linked to GDP growth. There are many developments in China that actually we're quite encouraged by, that we think will be relatively insulated from some of these tariff squabbles. Although in the short term, certainly sentiment is something that can have an impact on markets.
Maybe switching gears a little bit to the European part of the economy. What policy path do you see Europe taking on to stimulate their own growth?
Sure. I mean, look, stimulus definitely comes from the ECB. Originally, we expected the ECB to hike rates like the US did. That hasn't happened. And if you look at the forward rates, which one on the short-term rates is called Euribor, that one is telling you that until end of 2020, you will not see any kind of short-term interest rate hike. So we're actually still in negative territory. This morning we were minus 27 basis points. So what it will be, I mean, it will be cheap money in Europe for the foreseeable future. We're talking about at least 1.5 years, perhaps even longer. That is definitely helpful. Secondly, we will have another round of LTROs, which is financing for the banking sector. Most of the banks actually do not need that anymore. That was an instrument which was used after the financial crisis. And most of the banks in the northern part of Europe are, and even in the middle, are enough capitalized. The problematic ones are in the south, particularly Greece and Italy, and Spain to a lesser extent. They probably will take that kind of money and will invest it in their local bond market and will create a positive spread, which will be an extra income, and that will be positive for the overall capital. So that is overall a good thing, and that will happen over the next few years. But on the other hand, I mean, we have seen already quite some improvements in Europe. It's not that it hasn't happened since the ECB started the stimulus via the quantitative easing. The major quantitative easing stimulus came in 2015. The consumer is pretty well off in Europe. Unemployment rates are close to the lows which we have seen before the financial crisis. We have seen wage growth in most parts, particularly in the north. We have even in some countries like Germany or Holland, particularly the north again, we have even shortage of skilled labor. So it's not that it hasn't happened. We are there. As I said earlier, we need the next push coming from the corporate side. That is the important part. And then policy changes would be the next one, I guess, right?
Well, the policy changes are unlikely to come too much, I think, from ECB. Really, now it's time for some changes at the sort of fiscal level. So the ECB has done a lot. I think making monetary policy as easy as it is has definitely taken the stress off and allowed restructuring. So we see a lot of encouraging signs there. Certainly when you look at things like earnings growth, what you see with the weaker currency is that many of these large European companies that have external businesses outside of Europe, the earnings are quite flattered by the currency returns. Just the translation from strong dollar to weak euro has meant that earnings growth looks like it's reaccelerating nicely in Europe, and that's kind of getting people's attention. Also, low rates means that you finance M&A, acquisitions, and we are seeing a relatively strong M&A globally, but also in Europe. Europe has been pretty active in M&A. And the other thing with the weaker currency is that we also know that Europe has a pretty high component of its companies that have business in emerging markets. So again, that's flattered in terms of the earnings translation. So we're feeling pretty good about what we see going on in Europe. Yes, we know there's always political noise. If you tell me an area that doesn't have political noise, I'd be surprised. I mean, it's a fact of life, and with the internet, I think it will be more and more so. But frankly, many of the things that we're seeing, the corporates we're talking to, we're very encouraged.
So given that backdrop, and given the fact that the benchmark is a pretty significant weighting for Europe in general, how does that, what implications does that have for your strategy from a sector perspective, say financials, for example, or industrial?
Sure.
How does that play itself out in the portfolio?
I mean, look, in terms of financials, which is my specialty, good. So here, clearly, we have an underweight in banks in general, all over the world, because we do not see necessarily the yield curve working in our favor. Normally, a steepening of the yield curve goes into a direction which makes banks more money. That I don't see. That's the reason why we are basically where we're underweight. So it's very different to the U.S., where you had this big move in banks from 2010 into 2017 due to the steepening of the yield curve and the and the loan growth which was coming with the upswing. So that's not happening. Where we put our money is into a higher weights higher growth, which would be stock exchanges as well as insurances. But insurances in particular in Asia, so where we are in China and in Asia with AIA and Penang, which have done also fairly well, knock on wood, for us over the last years.
Okay.
So one of the things that, for those of you who don't know this strategy well, is we're looking to put investments in every sector that we can find that we think grows above the market for sort of a long period of time. You can see at the bottom of the slide in utilities and real estate, we don't have investments there. Because we think that the ideas that we see are not particularly interesting. They're either very expensive, and we think that the duration of growth is low, or simply that there isn't enough growth relative to the other opportunities. But by and large, what you see is a very broad representation across many, many sectors, including financials, which is not an area I think you would typically see in a growth portfolio. We're nearly neutral to our benchmark, but if you look underneath that sector, there's some very, very key differences among the subsector investments, meaning very low in banks, but very high in areas like stock exchanges, which we think can grow for a long period of time, insurance, and so on. So, but we want to have a lot of representation in as many sectors as we can. That way, when the markets have these nice upward moves, we participate in a very broad way.
And I guess this is a great transition into the portfolio around, Elisa, you've often said to us in terms of portfolio construction that you don't believe growth is one size fits all. And if you could help us or tease that out in terms of the different types of growth stocks that you own in the portfolio.
Sure. So again, for people that may be a little bit less familiar with how we do things here, we have a very holistic approach to growth, and one of the things we do know is that growth can be riskier than other types of investments, primarily because it's expensive. So we try to understand the different types of growth investments that are out there. We segment them very carefully into 3 different groups. We want to have as many different types of growth ideas in the portfolio, but we understand within each segment there are different levels of risk. Controlling the risk in the portfolio is something that's very important to us. We look to generate portfolio volatility in line with our benchmark. So what that means is we have an EFA core benchmark. We want the portfolio to be as volatile as the benchmark, not a lot more volatile. So, but we know that growth is riskier, so how do we deliver that? Again, segmenting growth in this very holistic approach we think is a way to do that. The other thing that we want to do is this is not just overall bracketing growth. Within each segment as well, we also think very much about diversifying among different types of growth ideas. So maybe very quickly, you can see all the way on the right is emerging growth. These are top-line primarily driven companies. They're very interesting companies. They grow very quickly, but they're also the riskiest. So it's important to control risk in this particular group and not go too high, because this is where you really see that portfolio volatility. An example of a name here is a company called Shopify, which is a Canadian company, an end-to-end web solution for small and even now larger companies as well. We take this total basket and we go up to 20% of our portfolio in emerging growth. Today we're probably about 11% in this particular group. It's very much driven by valuation. Again, this is a product that has a valuation approach to growth. We're intrinsic value investors, and that valuation is, our valuation metric is free cash flow. So that's what drives what it is, what we think a company is worth. But the riskiest part is always emerging. Now, in the middle is secular growth. This is 40 to 60% of the portfolio, always. This is also the least risky part of where we invest. These are larger cap companies, very stable steady compounders, really does provide that portfolio stability over long periods of time, and it still grows above the market. These are companies like Diageo, Temenos, L'Oreal. Very steady companies. They grow very nicely above the market, and they do perform well in up and especially down markets. You get a lot of downside protection in this secular growth category. Something that we think is a little different in our strategy relative to other growth peers is our structural growth category all the way on the left. Risk-wise, that would probably sit in between secular and emerging. These are companies where we see a step change in forward earnings that the market doesn't see, a very, very specific change at the company level. Usually earnings are somewhat depressed, valuations are low. When these stocks work, they are very powerful ideas. So we like these ideas. There's a lot of different types of companies that can go into this particular basket. It can have a more secular backdrop like Shiseido in cosmetics. It can be industry consolidation like in flavors and fragrance, industrial gases. We have Linda in the portfolio. But these stocks can be very, very powerful and can grow for a long period of time above the market. We want to find them at an opportunistic point. We do that with a proprietary factor model we've developed. And then, again, all these different types of ideas with different risk characteristics, different volatility, really contributes to broad participation in a lot of different markets. And it's something we think really, really holds the portfolio in good shape. In terms of what does that mean to be positioned for many things, we want to have a lot of uncorrelated ideas. We don't want to have a lot of things that are all linked to the same idea. These are all very specific stock ideas within the portfolio that are not correlated to each other, even within one particular sector, such that when the market moves, you will see nice performance coming out of our stocks from a very fundamental bottom-up driven approach.
So let's give an example of that. We're talking about uncorrelated growth. So, for example, if I look at your industrials, Teleperformance, Canadian Pacific Rail, Rent-A-Kill, very different businesses. So if you just expand on that a little bit more and talk about sort of uncorrelated growth stories within industrials, for example.
Sure. Hold on, I'm just turning to I'm looking at my attribution slide, which nobody can see here.
Fill the time for Rent-A-Kill, just to give you an idea what it is, because it's normally not a name where you would think it's in a growth portfolio, but actually it is, because the underlying business in pest control grows 3 to 4% globally, but in emerging market 5 to 6. And they are basically also a roll-up story where they buy the little small and pop shops and increase their overall growth to 7, 8%. And at the bottom line, because of a much bigger network effect, and these mom and pop shops are normally in a territory where you are already, and the technician who comes to your house will, instead of visiting 5 or 6 people per day, as the distances are shorter, he can make 7 or 8 people at the same trip or the same day, and it will fall down straight to the bottom line in terms of margin. So you will have double-digit earnings grower or EBITDA, and even more so in terms of EPS. Highly cash generative, and it's one of these kind of defensive growth companies which also in a downturn will create good cash flows. That's what we're looking for. These are the ones which are compounding year by year by year. So that is one of the critical parts of our portfolio. So Elisa.
So we've been overweight the industrial space for quite some time. But again, if you go down and look at the industry level, it's quite diversified. It tends to be lower capital intensity, more services side, like as Michael said, Rent-A-Kill is an important stock in our portfolio. It's in our top 10. But we also have electrical equipment. So we have a company called Legrand that does small voltage parts for your home, for your business. It's really very good at helping in energy efficiency. And they have some really interesting market positions across the world. In professional services, there's a company we own called Technopro. They do engineering services, software services in Japan. This is a market that's very, very short on that talent, and they've accumulated a very nice pool of engineers, software engineers, and so on to be able to service that market. And it's growing very nicely in a market that has a shortage of people that really need to digitize and help bring Japan kind of up to global standards. And then we have the rails. Canadian Pacific has been a stock in the portfolio for a while. We have actually, recently had a small trim on that position, but it's a very good business, a very diversified business. It is somewhat more cyclical, but these are businesses with very good pricing power, which is something that we like, and incredibly cash generative. So it's very diversified around different segments. It tends to be less, overall the grouping in capital intensive than I would say, the IFA benchmark overall.
So we started off the conversation around the global or the macro backdrop.
Mm-hmm.
We pivoted towards your views on growth and how you want uncorrelated growth assets,
Correct.
as well as growth is not one size fits all. Given those two, let's reconcile those two aspects. And where are you finding opportunities today? Is it tech? Is it healthcare? Is it consumer? Is it technology? Where are you finding growth opportunities today, given the political backdrop and how you invest?
So we're very much valuation focused, as you know, in terms of idea generation and what we're looking at. So we're looking for good businesses. We're looking for good businesses at the right price. That's something that's very important to us. Healthcare, specifically pharmaceuticals, had been an area that we had been, back in 2015, quite large. We thought was quite expensive. And so we had taken that down in a meaningful way, and then we had been underweight for several years. So recently we've actually taken our healthcare positions up, specifically again on the pharmaceutical side. That's very, very much led by valuations, which are quite cheap for the names that we own in Roche and Novartis, which are two new names for the portfolio. So healthcare is something that is starting to see a meaningful change sort of relative to what we've seen in the past. Technology is growing for us, but that is just frankly through performance. We have a secular story, SAP, we've had in the portfolio for a long period of time with the belief that their cloud business and the changes they were doing were going to feed through into earnings. It's finally happened this quarter. So we've seen really good performance from some of our long-held large positions there. But again, it's very broad-based. The emerging growth stories like Shopify, that stock has done very well this year. So you see a lot of good performance from a number of different types of growth ideas, again, very uncorrelated with each other. Consumer discretionary and consumer staples, again, those are large overweights for us or overweights for us. But those stocks continue to do very well. They have good pricing power. Cash flows are strong. Share buybacks continue apace and possibly are even increasing. And we're just maintaining very good positions there, and there's not really a whole lot new to do.
And technology you mentioned, right? Software is for us a big part. It's not only the SAP, but it's also a lot of companies which help actually to disrupt other sectors, right? So you mentioned Temenos, for example. This is a disruptor for new incoming banks that do banking software, and we haven't seen a lot of outsourcing to third-party software vendors in the banking sector, opposite to SAP and Oracle, who cater mainly to the industrial sector, where outsourcing has happened already to a degree of 90%. In banks, we might have gone past from 10 to just about 20. So there's a long way to go. I'm not saying that it will reach like SAP and Oracle at 90%, but even to 40 or 50% is doubling the TAM for these kind of businesses. And Temenos is world market leader and addressing a hell lot of larger banks in the world too, and it's coming also to the US. The first wins were noted in the last 1 or 2 years. So software and disruption is a critical part of our investment.
And so, one area that everyone loves to talk about, and I hate to go back to the China well for a minute here, but I'd like to go back to the emerging markets well for a minute. Mm-hmm. That's been an area where folks want to continue to see growth, of course. But in the context of your portfolio, how do you view emerging market companies as a total percentage of your portfolio, and how do you think about that overall in general?
So earlier, what I had said about portfolio volatility, we want portfolio volatility to be in line with our core EFA benchmark. When you add emerging markets, you are naturally going to increase that portfolio volatility. So you have to make an assessment as to, do you have enough upside? Is that risk worth it? And then you have to try to make that balance. So this product will go up to 10% in emerging markets. At the moment, we are about 8% in our holdings, and our portfolio volatility is not meaningfully above our EFA core benchmark. We've seen very strong performance out of our emerging market companies. Markets like Japan can be very difficult markets to find good growth. Many of the markets in Asia, Australia as an example, is also a market that doesn't have a lot of growth. So what is there is quite expensive. What we found is that actually within China, that growth is not particularly overpriced. It's actually pretty well priced. So we think that growth can continue for a long period of time because of structural changes in those economies, and we don't think that the market is pricing for that. So we're comfortable with the names that we own in China. We think they can grow for a long period of time, which is not the case for other parts of the world, and we don't think that the volatility that they bring into the portfolio is particularly destabilizing.
We've got a couple more minutes here, and so how about we round out the conversation with respect to performance and what's really been driving that over the last several years with respect to performance last year, with respect to what was pretty much a down market up until it was a positive market up until September, and then the fourth quarter hit, and it was just. But walk us through how you envision the portfolio to behave in different market environments. Clearly, if we look at your calendar year returns, it's been fantastic. But how do you envision the portfolio to behave in the context of how you construct it?
So one of the things we haven't talked about when we sell stocks. So we sell stocks when we think that they're fully priced, and this is something that we think about a lot. If you look at overall portfolio turnover, it's on a trailing 12-month basis, it's running at about a little over 30%. About a third of that are trims and adds. The rest are full sales and new buys. So we will we will move when we think things are fully priced for growth characteristics. So how the fourth quarter last year was certainly not fun, but we did go and evaluate how the different groups of growth actually performed in those markets. And we were really pleased that actually the way that we build our portfolio and think about our portfolio with the secular growth group being the largest is also the least risky. And that's exactly what happened in the downturn. It really did protect on the downside, and it fell far less than the market. Emerging growth, as we know, is the riskiest part of the market, and it fell the most, and it was pretty painful. But it didn't destabilize the overall return, and that's why we think this is probably the most important segment of growth to get right in terms of portfolio construction. And then the structural, again, behaved in between those two. Some did well, some did not. Overall, that particular group was better than emerging growth, but it was worse than the secular group. So how would I expect our portfolio to behave? Frankly, in most markets, we expect this portfolio to outperform. We do know we've been in a better environment for growth. So if we have a narrow value-driven market, we think that the portfolio could potentially underperform. But we don't really see that really happening because you need to have very good, long, economic growth in front of you, we think, for value to really work. Do you want to comment on those numbers?
I think one of the things that I find with respect to the characteristics of your strategy is that going back to the performance stories, your amazing up-down capture, 95% roughly on the upside for the past 3 to 5 years, and then on the downside about 75% down capture. Is that really a function of kind of how you were thinking about the sort of growth is not one size fits all approach? Is that how you were thinking the portfolio would behave?
Well, we're glad it's behaved that way, and yeah, we'd like to say we designed it that way. But we do think that what we're strong in is stock picking. We think that that's something that we understand, and we think we do a good job at that. We are driving for portfolio alpha to come from stock picking. We minimize something we call our factor risk. So this is how overweight are you relative to different currency baskets, different countries, sectors, etc. We do not try to outperform by making a call on a market or a currency. The performance is always going to come from the stock level. And when you go and look at the attribution, that's the thing we're really the most pleased with, is that when you look at the total impact. So I'm looking at my year to the end of April 2019 numbers, which we did roughly 600 basis points on our ADR strategy, a little bit more actually. 470 of that came from stock selection, and that's the thing that we think is the most important thing to understand. And importantly, it's very broad across different sectors. It didn't all come from IT or healthcare. It came from every sector except one, which was materials, where we did underperform on a stock picking basis.
And Nick, you have this slide there about yearly performance. Perhaps a lot of people will question, so what happened in 2017 and 16? I mean, 16 we underperformed slightly because we had this massive value rally in quarter 4 2016. But that reversed a little bit, and our quality and our growth credentials in the portfolio gave us a big boost at the first and second quarter in 2017. So very often we say 2017 is actually, or the outperformance of 2017 is the product of 2 years, 2016 and 2017, right, because it was this kind of weird moment in quarter 4 2016 to quarter 1 2017.
Perfect. There was a question that came through if we have an SMA version of this strategy, and the answer is yes. If you think about how ClearBridge approaches strategies, it's very much a vehicle agnostic approach. That is to say, there's a strategy and then the underlying vehicles, and so there is an SMA, there is a mutual fund as well as a CIT. So we take a very much of a vehicle agnostic approach. I think that will be the conclusion of our formal comments today. I think we've addressed all the major topics that we wanted to touch on with respect to macro as well as portfolio construction. Elisa, Michael, thank you for your time today, and kudos to your continued success.
Thanks.
Thank you very much, and thanks everybody for listening.
Thanks to all our participants for joining us today. We hope you found this webcast presentation informative. This concludes our webcast, and you may now disconnect. Have a good day.